In today's lesson, we're going to be back testing an unbalanced condor made with puts, and we're going to test it over the crash over a very difficult month in 2008. We want to look at the changes that we see in the profit and loss, and also study how the margins change if you're trading a portfolio margin account. The structure of this trade is moving from the left to the right. So we have a 3 delta here, 6 delta here, 56 delta here, and a 62 delta here on the puts. And we're looking at the SPX. And we have a ratio of 5 to 2. So in this case, we have 50 contracts over here and 20 contracts over here. The initial margin of this trade using the standard Tim's risk model measuring up and down 10% is only about $10,000. We'll make a note of that. And our initial credit in here, which I call the bar, based on that Tim's margining method, is actually 324% up here. If you're not familiar with the Tim's model, then briefly it measures down 10%, so your margin is calculated there, and it measures up 10%, and then there's a risk array that's created within that plus or minus 10% span, and then the algorithm looks for the lowest point on your day step line. So for example, this side shows a drawdown of 7,400 over here at 10%. We're looking at the 9,700. So the margin's calculated on this side. And then they also add in an additional 3,750 per contract. So in this case, there's 140 contracts, so you multiply that by 3,750. That amount is added in there just in case the broker liquidates your account, so you can expect that type of slippage. So it's an extra buffer. And that's pretty much the out-of-box standard Tim's calculation. It assumes that the volatility of the underlying will remain the same. As we move forward in this trade, again, I specifically chose a difficult time because when we develop our option strategies, we always analyze the worst case as well as, all the standard deviation months. But in this particular class, we're going to look at a stressful time. So on the first day, SPX moves down 8.81%. And then we want to note down here that our margin has already jumped to 43,000. So we started with 9.7 and it jumped to 43. So we can see very quickly the margin quadrupled. So we have an increase in margin about 400%. Simultaneously, the drawdown on the trade is already 10,000, which is actually about 100% drawdown based on your initial margin. These are the things we need to be aware of when we're constructing our trades and when we're trying to work with portfolio margin, because it's a very dynamic and fast-changing margining system. I also want to note, let's just back up, that this particular trade is designed with negative delta in here, which you can see, negative 24 points. The Vega positioning of the trade, we can see here, is negative. And as we increase volatility, we see the Vega position becomes more negative, which indicates the trade has a negative Vomma position. Although the negative Vomma in the trade isn't too bad. But we can also see that as we move the mouse to the left here, if you're looking down at the bottom of the screen at your Vega down here, that the Vega position becomes more negative. So that's caused by the Vanna position. So when we're creating these types of trades, we want to observe how our Vega changes relative to the price changes, as well as relative to the changes in volatility. Now we can also see as we move this way that our Vega is becoming more positive. Again, if you look down at the bottom of the screen, that our Vega becomes more positive. If we have a positive Vanna in the trade, and then you have a positive change in price, you multiply the positive times the positive, and you get a positive change. As we have a positive Vanna and the price goes down, now you have a negative number multiplied by a positive Vanna, and you get a negative change in your Vega. So I can quickly see that the trade has a positive Vanna position, and I can see how it's changing my Vega as I move the mouse left and then to the right. Now, what does that mean? Well, typically, but not always, the volatility moves opposite direction of the price. So as we go down, then we can expect an increase in volatility. And then as we go to the right, we can expect a drop in volatility, which means that the Vega position on this trade structure actually moves backwards. So that's one thing we want to be aware of. Now, the benefits of the trade, we have, as you can see, plenty of positive theta. We have a really wide range of a profit zone because it covers actually 20% down this way, and then the profit zone this way will also cover quite a bit of a range because of the positive theta. Another thing to note, if the market moves down rather slowly, then you probably wouldn't have much a problem with the negative Vega. So the real exposure is if the market moves down really fast, like what we're stress testing now. And then if you move up really fast, but you don't have as much risk over here because this unbalanced design, you have a lot less risk on the right side, as you can see. Okay, then of course you could throw in adjustments, which we'll get to in a minute, but if you move this far down, in this case we do. So if we move down here, and then you start to adjust the trade, then by adding protection over here, for example, it's going to lower this side, so you end up with a condor structure with a lot of risk on the left and the right side of the trade. So it sort of defeats the purpose if you move down and you really adjust it. And then your other option, again, you can always move the whole trade farther to the left and things. But anyway, let's fast forward and take a look at that. So as we see, the first day we move down, there's a spike in volatility, and the trade's down 10,000. So it's basically down 100% of that initial margin. Our margin quickly jumped up 400% to 43,000. The other thing we want to note is we're at about 1106. Let's go back to the beginning of the trade. So at the 1106, the beginning of the trade models a drawdown of about 6,000, a little bit more, maybe close to 7,000. But in reality, it was down about 10,000. So there's a difference there in about 30% from the increase in the volatility. So I just wanted to note that. Let's fast forward a few more days. And so in this case, we can see as we go through time, our margins increase quite a bit. So if your trading plan is to simply trade on probability and let the trade ride and make no adjustments, this is what would have happened. So quickly the trade's down 100,000. Again, you started with a initial margin of only 10,000, and now just after 2 weeks, this trade is down 10 times your initial margin. Your margins also increased to 151,000. Again, that's 15 times your initial margin. So an increase in margin of 1,500% in just a couple of weeks. Fast forward a little bit more. SPX moves up. But we also see, even though, we're approaching the body of the trade, there's still significant drawdown there of 66,000, and your margin's still 120,000. So again, with this sharp of an increase in margin requirements. Most likely you would have to exit the trade, size down, you'll have a margin call, and so on. Now, if you were to stay in the trade and size down, then note that your credit here, your bar at 31,000 is going to be way below zero, so you'll never be able to make back the money in this trade. As we go a few more days, margin again is at 150, trades down almost 100,000. And as we really complete about a month in the trade, again, margins at 176. P&L is now down 136,000. Again, this is an unbalanced condor. Again, using starting with -3, -6, delta -56, and -62. It's a 5x2, so we have 50 contracts here and 20 on this side. And it's really a high probability trade, but without any adjusting, you can see what would happen. But even if you did actually be forced to adjust, then the whole trade would be way down here, and there's no way to make money on it. And then you would end up with a condor style where you just have a lot of risk on the right side and on the left side. So I guess I'll leave it there. Just want to make you fully aware of what could happen if you are trading this particular strategy during a market debacle. I hope you enjoyed that. Thanks.